So first of all, let's get right to it. Why the slow pickup in corporate debt? We've seen obviously the sovereign bond market has stabilized. We've seen a 20-year yield curve established, but still very slow progress with regards to corporate bond issues.
Well, it's not surprising. If you go back to the FGN bonds you mentioned earlier, you recall in 2003 at the issuance of the first FGN 3-year bond of just about 30 billion. Today we're talking about FGN issuing 20-year paper at in hundreds of billions. So it's not so as slow as you think. I mean, going back to December 2009, going back to the GT bond, you recall that last year in 2010, you actually had about 3 major corporates who came to the market to raise capital through the debt capital markets. You have UBA, you have UPDC, you have flour mills, and at the tail end of the year, in December precisely, Chelarams PLC also raised some money, and including flour mills. So it's not as slow as you think, and you recall that also last year, all the issues last year actually occurred in the second half of the year. And I can tell you, at least from my position, that you would probably see the closure of 1 or 2 corporate bonds this month in June, that is. And also the outlook for the market is equally optimistic for the rest of the year.
Yeah, but the thing is, relative to the potential size of this market, in fact, maybe we should even get to that. How big can this market realistically be for these corporate bonds issues? We'll have to look at the quality of the issuers here. You did mention GT Bank issuing a bond, and really, we really have to count on one hand or so how many big issues we've seen on the corporate bonds. Yes, we've seen some smaller ones, but realistically, how big can this market be?
Well, rightly so. If you look at it from the global context, ideally, the ratio of equity market to debt market, ideally we should be about 10 to 1. That's equity being 1 and debt being 1. So that tells you the potential that lies in the market. However, if you take it away from the global perspective and come to our domestic scene, like you rightly mentioned, the quality of the issuers, I reckon we have the potential to match debt to equity about 5 times, i.e. you have market capitalization of equities doing about 6-7 trillion. Now that means you can do that 5 times over. And all you need is just for investors to be more confident in the ability of issuers in the market. I mean, if you look at the, recently, trustees have been coming to the market talking about coupon payments. GT Bond has been paying its coupons, and all the other issues have been paying. Once the market settles and confidence is built in the market, you actually have investors who actually be knocking on your door asking for corporate bonds. We've seen examples in other markets, and we believe Nigeria has all that potential also. Addressing the issue of the quality of the issuers, I think that can be addressed with the rating. The fact that these bonds are being rated actually addresses that fact. Either it's investment grade or non-investment grade. And of course, the issuer will pay for that through the coupons on those bonds. So I think the Nigerian market actually has huge potential for growth beyond what one can really think.
But to the issuer, what's the strong case for to issue bonds in the first place? Yes, we've heard of waivers being given to encourage bonds issues. We've heard of even the pension laws have been redefined somewhat to accommodate corporate bonds, but still we're still very slow issuance, at least in my view anyway. What is the big case for a corporate bond issue? More so because now that interest rates are rising, if you're going to issue for long tenors, it means that you're going to obviously pay a lot more.
Well, it depends on the angle from which you're looking at it. Thankfully, the Nigerian environment is such that you have banks giving out more often than not short-term loans for issuers to finance expansion, which are obviously our long-term financing needs. Now, the point is that that's more than enough attraction to the average issuer to raise bonds, which more often than not will be 10 or to a 3, 5 or 7 year, and we haven't seen 10 or 20 year corporate bonds yet. So that's more than enough attraction. The ability for issuers to match their financing needs with their financing. You have a 5-year or 7-year expansion program. You do a bond, of course, to match your assets and your liabilities rather than actually going for more expensive bank loans, which are more often than not short-tenured, and interest rates also are equally volatile at that end of the spectrum compared to if you issue a fixed-rate bond. We've had issues where investors have requested for floating-rate bonds or maybe bonds indexed to inflation or something like that, but that has to do with a particular transaction. But the point is that issuers in Nigeria have more than enough reason to actually tap into the funds in the debt markets.
All right. Unfortunately, I have to wrap after this. Final word very quickly on the infrastructure. We have the FDMA platform being used to trade fixed income on the government side right now. How strong is infrastructure to do the corporate bonds? Very quickly.
Well, the infrastructure is quite strong. All you need to do is to look at probably revision of existing guidelines in FMDA, Financial Markets Dealers Association rules, for them to be able to accommodate sub-sovereign and corporate bonds.